Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is our weekend wrap-up where I try to answer some questions sent in to me by my readers from email. And I had a lot of emails about indicators and the indicators I use, but emails about other indicators also. I had so many questions, I'm not going to read just one letter, but it's a great topic, so we'll spend some time talking about it. I also want to share with you a little practice that some of the funds and institutions use from time to time. It may help explain some of the weird movements in some of the stock holdings that you've had in the past. Hopefully you'll find this interesting. Anyway, let's get to our indicators. The indicators questions went from the Super Bowl indicator to the January effect indicator to the sell in May, go away theory, and also my own personal indicators that I've been using. So let's go to the least important of all of them first, the Super Bowl indicator. Completely useless. Sometimes it's right, sometimes it's wrong. It's a fun thing to look at, but after that, just throw it out the window, disregard it. The next indicator is the January indicator. Now, the believers of this indicator will say, as goes the first 3 days, goes the month of January. As goes the month of January, so goes the entire year. Now, I find that to be a bit of a stretch because sometimes it's right, sometimes it's wrong, especially in the short run. I mean, maybe the first 3 days may turn out to be right that the whole month is down, but maybe it doesn't. But once they start telling you the month of January dictates the entire year, that's a bit of a stretch for me. And then they say if it's not the first 3 days, well, then it's the best out of the first 5 days dictated. So it keeps changing, and sometimes it's right, sometimes it's wrong. But I take my cues from the direction of the market. I'm a trend player. I try to identify the beginning of a trend, get on board, and try and ride it the best I can. And that's what I take my cues from, not any January indicator. Now that leads us into the sell in May and go away theory. Now, believe it or not, there is something to this theory, but as a trader, it's kind of hard not to trade for 6 months out of the year. But there's a firm called Dorsey, Wright and Associates that did a survey that goes back 20 or 25 years. And they've measured investments that you bought, let's say in November, and held on till May, versus investments that you bought in May and held on to October, and the rate of return is so much greater, it just jumps out at you. It's really amazing. So there is something to the theory about sell in May and go away, but these are if you're a long-term investor. If you're traders, it's too long of a period of time. So yes, there is something to the sell in May and go away, but it also dictates the fact that summertime is slow and people are away on vacation. So it's an interesting indicator. Not something I would use to trade off of, but there is some validity to the saying sell in May and go away. All right, that leads me to my own indicators. Everyone wants to know what my indicators I use. I cannot give you the calculations as it's proprietary, and I spent a lot of time figuring it out, and I've had some help. But I will tell you some of the ingredients that go into it. Okay, there's a number of factors. The first factor is pattern recognition. The second factor is a oscillator. Now the oscillator is an overbought, oversold indicator. It can be calculated in many, many different ways. You need to find what the calculation that's right for you. But it also acts as a momentum indicator. So it's got a dual purpose. And then I have a timing indicator that gets put into the mix, and then we calculate it all together. And then the hard part of the indicator is the interpretation. So you have to be able to understand what that indicator is telling you at that moment. And good indicators will work a lot of times. They don't work every time, but a lot of times they do work. So I strongly suggest that you start putting together your own indicators. You're going to have to experiment with them for a while. Don't get too many because you'll get too confused, and sometimes you'll find out that they start to contradict one another. So get yourself 3 or 4 good indicators that you like to use that will work well with each other. Let's talk about indicators for a while. Indicators are to a technician as a carpenter has a hammer and a saw. That's what indicators are to a technician. Okay, and they're extremely useful. Are they right all the time? No. Are they the holy grail? No. Because I'm here to tell you, Stop your search for the Holy Grail. There is none. There is no magic formula. There is no magic pattern. There is no one piece of perfect information that you're going to get that's always going to work all the time. It just doesn't exist. I've seen hundreds and hundreds and hundreds of traders look for this magic formula, this Holy Grail, and it doesn't exist. You need to stay fluid. You need to keep being flexible. And you need to be able to change your mind when you have to, on a dime sometimes. That's how fluid this market, this game really is. So stop looking for the Holy Grail. It doesn't exist. You know, back in the late 70s, early 80s, there was a famous technician called Joe Granville. And for a couple of years, every turn of the market he called. He was unbelievable. Every turn. And then all of a sudden, in 82, his formula went off, and he never made another right call after that. Or he made so few that he faded away off into no-no land somewhere. But it just goes to show you that the formulas work for a certain period of time, and then they don't work anymore. And if you continue to use them, they'll be your detriment. Let's take the long-term capital management, where they had a formula that worked so well in the debt market for years, and all of a sudden it didn't work, but they continued to use it. They wound up going bankrupt. So tech indicators, extremely helpful, but you need to stay fluid. Okay, that leads me into my next piece of information I want to give you. It's a little practice that big funds and institutions use. Not all the time and not all of them, but I need you to be aware of this little practice because it may answer some of your questions. I'm going to set up a scenario. Let's take institution ABC. They've got 2 million shares of XYZ to sell, and it only trades maybe 1 million shares a day. So they give the order to their broker. The broker says, well, this is going to take a while. No problem. It'll take a couple of days. So the first day they walk in and they see a bid down 2 cents for 20,000 shares. Bang, they hit it and they walk away. They're gone for half an hour. They let the book rebuild. They come back again. They see another bid maybe down another penny or even at the last sale for 15,000. Bang, they hit that. And they very quietly keep doing this all day. So by the end of the day, now they've got 100,000 sold or maybe 200,000 sold. And they've done it very quietly without upsetting the marketplace. And so this goes on for a couple of days. Now they've sold, out of the 2 million, they've sold, let's say, 990,000 shares. And now they've got 100,000 left, or 200,000 left, let's say. And with that last 100 or 200,000, they drive the price of the stock down as far and as fast as they can. So what they're doing is they're making, not only are they scaring everybody else who owns the stock, but they are trying to create an average price where their sales, their earlier sales, all look good. They're above the average price of the day. So that's the little game that they play, because most of the time they're compensated on how well they executed the entire order. So if 90% of their order gets executed at a very high price, then they look good and they get paid more money. And the same practice goes on the buy side. They buy 200, they buy 200, they buy, and then the last 200,000 shares, they jam the stock up as high as they can because they're trying to create a higher average, and on the sell side they're trying to create a lower high. On the sell side they're trying to create a higher average. On the buy side they're trying to create a lower average, and it makes them look good. Now this may not happen all the time in all your stocks, but I think you might find it interesting, and it may explain some of the weird moves that some of your stocks have had in the past. Okay, I hope this is you find this question and answer period educational and interesting. And until we speak again, this is TK signing off.